Good evening, everybody. What's going on, family? What's up? What's up? What's up? Happy FOMC Day, interest rate decision day. Oh man, it's already been an exciting day with CPI release this morning. And now we are here at 1:50 p.m., a little bit before the interest rate decision coming up at 2, followed by the FOMC press conference led by Mr. Jerome Powell. Mr. Green Laser Eyes over here. Let's bring him up one more time. Look at him. That's what he's ready to do. Ready to print money, man. As he's already kind of been doing. Well, not him in particular, but as the market has already been doing today. Up a beautiful 1.2%, 1.3% on the NQ since about 8:30 this morning. All right. It is also Economic Projections Day. So besides just the interest rate decision, which is widely expected to, again, come out at about 5.5% here, no change coming out of the interest rates. It would be funny to see a surprise cut. I would definitely get a good laugh out of that. But outside of that, not looking at many changes. We do have economic projections, which will be the highlights of what I'll be personally looking for, as well as comments from Powell himself. So let me see if I can bring some stuff up real quick. If the music is at a good level, I'm actually going to turn this down just a little bit more. But let me know if the music's at a good volume, if y'all can hear me clear. Let's see what we got in chat. We got Mark in chat. We got Free Zone Lou in chat. The rest of y'all are quiet. It's okay. Middle of the day, if y'all tapping in from work, I appreciate y'all. Let's see if we can bring it up over here. Alright, it's 9 minutes to release. I'm just trying to pull up some of the Fed website here. Let's see, volume's good. Let's go. What up, Saint? How we doing, bro? Good to see you back on stream. Alright, let's see. Pull up the March projections. Honestly, I think I would be surprised if they change any of the economic projections for this year. We might see some shifts for 2025. The forecasts, or at least the, let me switch you guys over real quick. Even this, like looking at this coming out at like almost between 4.5% and 4 3/4. I'm not a believer that we do significant cuts this year. If you guys follow me over on Twitter or X, whatever you want to call it, I had tweeted out before that basically my little roadmap for when I expect the Fed to cut rates and all that fun stuff. Basically, not looking at them to make a move until September for a 25 basis point cut, and then maybe another one in December, which would be 2 cuts. But even then, if we do 2 25 basis point cut, that doesn't really put us down at this 4.5 range. So I'd be interested to see where some of the target plots are, especially for 2025. I think this is a little optimistic as well. Nothing wrong with that though. Alright, we are 6 minutes out fun release. Let's see what we have in chat. A little sad about the DXY, but other than that, I'm don't be sad, man. It's always a good day when the dollar index is bearish. Listen, for those of you guys that have assets that buy things that go up in value long term, it's always good to see the DXY with gap down like that. Let's see, 1 max, unless something changes, no more than 25 basis points. I don't know, man. I believe in a little bit more than that. I believe that we get 2 rate cuts. Again, albeit I think the second one does come in December at the end of the year, and that's a big maybe. So I guess I'm not that far off from what you're looking at either, but I do root for the December cut. I think we're all but guaranteed to get one in September and by September or November. It's possible the Fed moves earlier. I've been saying all year that as long as they don't move before June, that we should be good to cut at the end of the year, and that's been looking good. And as we sit here in June, again, my thought process remains the same: is that we get 2 cuts at the end of the year, test the waters a little bit. Again, they're gonna highlight. They're gonna take it month by month after they start cutting. And I don't think we commit to consistent cuts until 2025, and that's what I'm curious about. What we're gonna get. I'm curious to see where we end up for some of the economic projections in 2025. I don't really care about 2024. 2024 to me is like, I know we're getting 1, we might get 2, 3 would be a little bit aggressive, but again, unemployment's about to jump above 4%. I think they're gonna want to try to get ahead of that, at least maybe in the public eye, even though that's just a ticking time bomb. But yeah, I'm curious to see what the path for 2025 looks like. Also curious to see if they change. This is from March, by the way. This is the economic projections from March. But I'm curious again what they look at for the unemployment rate. We talked about this last time too when I was live, about the unemployment rate and some of their expectations. We're here. We're at 4%, man. These I'm curious if these change, and I'm curious by how much. But and whether they do change or not really doesn't matter to me. I have a strong feeling of where I think unemployment is going. And again, I tweeted this earlier today, but again, by end of year, 4.5%, pretty realistic unemployment rate. Again, not something I want to happen, not something I cheer for, but something I see happening. And then into 2025, I mean, it can get real bad if everything kind of comes together. So we could be looking at like 5-6% unemployment at like the peak if that train continues in its path. So I'm curious to see what they do here, if they change any of this. I was very surprised that they kept this low. Again, we're already at 4%. They don't want to spook the market and be like, hey, it's, we see this getting out of control, but at the same time, I think reality has to set in that these are no longer proper projections for unemployment on any degree. And some of these are even crazier. I mean, like the upper range being 4.3. Again, I think you're above that by the end of the year. So I'd be surprised, man. I really would, if they don't make changes there. We're about 2 minutes out. I'll keep you guys on charts here until I get some of the data up and go through it. Of course, I'm just going to be narrating. Again, there might be some opportunity in the market. I mean, you're probably going to want to wait for Powell to speak, but like, I mean, shit, at this point, if you can get something below this range, if you want to try to scalp some momentum, I wouldn't try to sell unless I hear comments from him, which even then, I mean, there's really no world in which you're asking me to sell this. So, especially when we're talking about them, projecting, potential future rate cuts. Even if you were to sell this and it were to move down, you should document that as, I like to gamble and I got lucky. Because outside of that, I think you're just delusional. But hey, man, whatever makes y'all money at the end of the day. Chat pretty quiet. Let me see. We got 45 seconds here. And we get to do my favorite thing, which is break down and speculate on data. Usually takes the Fed like 2 minutes to get stuff up on the website here. Hoping they're pretty quick. I do not pay exorbitant amounts of money for Bloomberg terminals, so... Alright. Dollar with some strength there. Let's see what we get out of the report. Oh, beautiful. Beautiful quick upload. Alright, let's see. Recent indicators suggest that new external solid pace. Job gains have remained strong. Yeah, sure. If you believe the last NFP report, sure. If you think losing 400,000 full-time jobs and replacing it with 600,000 part-time jobs is good, that's sure, then job gains have certainly remained strong in your delusional sense of the word strong. And the unemployment rate has remained low. It's the highest it's been in 2.5 years since COVID. That's teach their own. Inflation has eased over the past year but remains elevated. Yeah, it's okay, we know that. In recent months, there's been modest further progress. It's 2% objective, no surprise there. Maintain the target range, okay, there's no surprise there either. Let's see. They raised projections, it seems like. Let's go to the doc graph real quick. Hold on. Why don't... Where are the economic projections? There they are. Alright, let's see what projections say here. Okay, so they have made some adjustments to unemployment rate. Not by much. They're like the... Okay, 4.2 in 2025. What was it previously? 4.1. Yeah, I still think that's... Okay. You know what this tells me? This tells me that they acknowledge the fact. So it's so funny that they think that they can say. It's so funny that they say this. Job gains have remained strong and the unemployment rate has remained low. But yet you're forecasting it to go up. A little ballsy of a statement there. Although the range and the central tendency have not changed. Okay. GDP expectations, let's see, it was 2.62320. Okay, so lower inflation, no, higher inflation targets. 2.8, 2.6, okay. Alright, let's see where this, okay, yeah, see, they adjusted this. This is exactly what I was just telling you guys too. It doesn't really make much sense for them to have target rates this low. Now, like I was saying, it's tough for them to get here, because even if they do 2 rate cuts at 25 basis points, this is where they end up. They end up at the 5% mark. They don't end up at 4.5%. They're not going to do a full percentage point decrease. So it looks like they're affirming that we're going to get 1, again, maybe 2 rate cuts. So exactly like we said, path remains the same. September, probably get that first one. Data will probably confirm that it's the right path in November, and then by December we'll get that second one. So that's beautiful. For 2025, it seems like they have also upped what they think their rate is going to be. This is good though. This is not a bad thing. So we're looking at going down to 4%. So we're looking at going from half of a basis point move this year, full basis move next year. So we can do, how many rate cuts does that put us into 2025? You could either do 4 or you could do 3. You could do 25, 25, 50. Okay, cool. Cool. I like this. I think this is probably... I see why the dollar gave the bullish reaction here. Because what's happening is... basically the Fed is projecting higher rates in the future than it was. Right? That's like the super basic way to put it. They're projecting higher rates in the future than they were previously. That's a better way to phrase it. Than they were previously. This is great for us because this, I mean, again, I don't think this shit's gonna pull back that far, and Powell probably gonna fucking still send this shit up. Like I said, this is probably just a liquidity grab. I mean, he might make some comments that maybe reinforces a little bit, but again, I would still trade away from this in the macro. So this will give the dollar some strength, again, because what this is basically telling the market is, like, if you were betting on the Fed doing, let's say, 3+ rate cuts for the remainder of this year, they're basically killing that idea in the water. They're not saying, hey, we're not going to reduce rates, but they're saying we're not committed to reducing rates to the expectation that we were previously. So this does give some initial dollar reactions, which is great. Now it's just a matter of what Powell says, and we have to kind of listen to what he is going to... he'll lay out the paths. Again, last time he laid out two paths, the inflationary path and the labor market path. We favor the labor market path because that's the more volatile path. If the labor market weakens and unemployment rises, that will expedite the Fed's thinking and will get them to lower rates quicker. Where if inflation just falls and the labor market remains strong, they're not going to see as much reason to cut rates. Not that they won't, but they'll take a less intensive path. So I want to hear some of his comments surrounding the jobs in the labor market. Again, I specifically want to see what they say. Because over here they say, again, job gains have remained strong and the unemployment rate has remained low. Again, I would disagree with this. I would disagree with this statement. That's just how I see it. I would disagree with this. And I think I have market data that also supports that. The only thing that doesn't support this, again, is the NFP number that we got last week. Which, again, I will say it for YouTube people because I don't only say it in the trade room, I believe. But last week's NFP number is bullshit, in my opinion. This is just not an accurate number. I don't believe. I don't think it's an accurate representation of the labor market. I think it's a cool, fancy number. I do. It's a cool, strong number, way above expectations. In that sense, it's great. I don't think it's an accurate representation, though. And I think when the next NFP number comes out, you'll also see that this has been revised down. This will probably come down. Probably at least 30k. I would say 50k. They'll probably adjust it down to like 218 or something stupid like that, like 50, 60,000. But I'm willing to bet it gets revised down. So I'm calling bullshit on this statement, and I want to see what Powell's got to say about it. Alright, that's enough of me just yapping, though. Let me see what y'all got here in chat, if anything. What's good, my brother? Oh, what's good, Devin? My bad, I was on a little bit of a rant there. But what's good, bro? Good to see you. Are we going to watch his speech live? Yeah, I'm going to pull it up. We're going to listen to about 10-15 minutes of it. Usually gets pretty repetitive after like 4 or 5 questions. The first questions will be about inflation. Then they'll get into like the labor market stuff. Then they'll get into some other bullshit that nobody cares about. Don't forget GDP was revised down as well. I don't really care about GDP. Again, not that it's not important, but it's just not a set of data that I think he cares about. And again, if you go back to the last time that he spoke, the last FOMC press conference, the reason why I don't care about GDP is because he says he got specifically asked if there or any paths that would expedite them cutting rates? Basically the sum of the question. And he laid out two paths, the inflationary path and the labor market path. He did not lay out a path that was like, if GDP does XYZ, then we'll do this. So therefore, it's just data that I don't care about. Please, what direction are we looking at? We look only bullish. We look bearish dollar, bullish indices, bullish gold, bullish any sort of foreign currency against the dollar. Again, that's kind of why we had this level marked out. Just some liquidity built up from the action pretty much since the market open. NASDAQ hasn't done anything since market open. Now it's just kind of swept a lot of that pre-market activity. Moving into Powell, if he reaffirms, again, some of the stuff that we just talked about, then, again, this is going to be clear for even more all-time highs. Again, I don't know why people would be looking primarily at sells. The NASDAQ is quite literally at all-time highs into an environment that supports rate cuts. There's, I don't know why anybody would be fighting this. Again, not that you can't make money on shorts on specific days, and maybe that today is even a day like that. But you'd have a lot easier of a time if you just traded bullish. Well, he laughed at stagflation. But I hate this little heart, bro. Can I move this, like... Will we revise GDP down? My only comment on that. Yeah, stagflation is also something I try to ignore. I don't really like to comment on it or look at it either. I think it's just a distraction term. Alright, stagflation is just one of those things that people say is like happening to justify markets moving sideways and all that fun stuff. Alright, let's take a look at what some other stuff did. What's gold doing? Let's move to a single chart here real quick. You know, I still would not be opposed, because especially with the double news, I wouldn't be opposed if we did, like, if the dollar did want to reclaim some stuff off Powell's comments, again, because they did revise the projections for this year and next year to have higher than previously thought interest rates, but they're still looking to cut. So I wouldn't be surprised if we erase this CPI move just to grab this liquidity that's sitting down here before we actually do go to erase back up to 2400. So I wouldn't be surprised, like, moving into next week, if this is something that we got. The only thing that would invalidate this, again, is if we get that stronger close above 2355, because this could very simply just be reaccumulating to move higher, just playing inside of like a little triangle formation until Powell says the right thing at the right time to push us up. But if we do start claiming below this 2337, I wouldn't doubt that we go all the way down to 2320 into next week, and then at that point we could start looking bullish as all the people say, oh, the market structure shift has changed, and at that point we can then start trading to the buy side. So this is like a possibility. And we kind of talked about this morning in the trade room too, is like with the double news, you have such a high chance of like a whipsaw day, because especially with like inflation, again, inflation looked great, completely justifies the rise up. Now some of the economic projections have changed, so again, there's some profit taking at like near the highs of the day. And there's like, if that profit taking gets exaggerated, then you start liquidating all these people that chase the news move, and then it's, you know, again, it's kind of a cascading effect. So you erase the news move completely, grab some liquidity, and then at that point, all the smarter money is like, well, the fundamentals are still the fundamentals. And then you just drag price back up. So yeah, I wouldn't be surprised, man. Not at all. And as somebody that doesn't have a macro position right now, I gotta say, I kind of favor that. Euro USD? Well, Euro USD would move very similar to gold, so it's gonna do the more or less the same thing that I just described. Euro USD. We really should have played it this week, huh? We were looking at it down here. We never pulled any executions off this. Choppy as hell down here too. Yeah, I mean, really, before I give like macro opinions on this, I would prefer to see what Powell's got to say. However, again, if depending on whether you're a swing trader, if you're just looking to like scalp, if you're looking to scalp, I would definitely be trading probably to the buy side. If you get another rejection off of up here, then I would cut the buy side for the day and probably trade short. But I think in the macro, I think I'm still looking for like 106, 750 to get taken. So again, I wouldn't be surprised if we if they use Powell today as a little bit of exit liquidity on this, make one more high and then come back down. And then again, at that point, once you take out 106.50, then you can start looking for like macro buys. The same thing we were looking at on YM this week as well. Which shit, we might even still get, man. We might even still get this chance down here at 38,300. I fucked this up too, dude. I had a buy on this last night when I took gold. And I set it at break even, and I was like, you know what? I'm gonna just hold this all night into new. I even had my TP set above this wick. I'm so annoyed, dude. And then I set gold to break even, and I was like, you know what? Let me just get out of YM and secure the money. And I don't even know why I did that at all. So rest in peace to $13,000 I could have made for the 680 that I think I closed on it. So stupid. Oh man, gotta love it. It's because you know what I said to myself too. Is that I said I'd rather make the money on gold, and I think I put like 2 extra contracts on gold instead. It was so dumb. And then gold broke me even overnight. Sad days. Everybody get out your tiny violins for me. My guy, what's good? How do we connect? I mean, bro, the best way to connect with me is either Instagram or Twitter. I mean, shit, if not the Discord, bro. Again, I do have a quote unquote free Discord. I say quote unquote because technically it's $1. So, and the reason that it's $1 is because it keeps out all the bullshit, right? So. We love that. Mr. Powell speaking at 1:30. Yes, 1:30 your time. It seems like. I mean, trading wise, I mean, right there, bro. Go to the WAP. I mean, either get in the main community for a buck and just vibe out, talk, chill. Or we have the live trade room, which is $49, and you can get my over the shoulder experience during the New York live trade session. Which is not me holding your hand with signals, and it's not me teaching you. But some would say that both happen either way. Alright, we got 12 minutes to Mr. Powell here. Let's go do a roundabout on Twitter and see what the retail people are saying about it. Let's see. Should I share Twitter? Should we try to share Twitter on YouTube? I feel like I'm gonna get like banned. Because Twitter got some wild shit on it sometimes. I don't know, man. We're gonna try it. It's my apologies if anything wild pops up. But just at Elon Musk and let him know. Let's see what we got here. FOMC holds rates as expected. Dot plot shifts more hawkish in 2024. We just discussed that, though. You don't need investing.com's late ass to tell you that. You got me. Federal Reserve pauses interest rate hikes from. Okay, yes, this is not news though. If price action leads fundamentals, why does the price action spike after economic data is released? Fundamental analysis is king. Sure. Okay. I don't disagree with you, but I mean, there's multiple things happening at one time. It's not like everything is happening simultaneously. Let's see. FOMC medium forecast shows 25 basis rate cuts in 24 versus 75. I got the impression that we were looking at 50, not 25. I guess you could say 25 is the guaranteed number, with the 50 being the maybe. The safe tweet. Aliens might be living among us, disguised as humans or on a base inside the moon, according to a new Harvard study. Okay. Great to know that, Harvard believes there's aliens living inside the moon. I mean, shit. That's what up. Yeah, it doesn't really look like there's anything going on in the Twitter space. Everybody just awaiting, Powell's comments here. Let's see, the Kabasi letter says, our general takeaway from the Fed interest rate decision, some modest surprises such as rate cut expectations for 2024 being cut down from 3 to 1. Why is that a surprise? Or how is that a surprise at all? I don't know if they say this just because I like this says our general key takeaway, so this has to be your belief. I don't know why you guys are surprised by that. I don't think 3 was ever on the table. The rate cut expectations in 2025 increased from 3 to 4, offsetting part of this shift. So this is what I was saying too. I'm curious, right? Because okay, so if they say that the target rate is potentially 4% in 2025, you could interpret that one of two ways. You could interpret that this way, that they're going from 3 cuts to potentially 4. This is assuming though that all of the cuts would be 25 basis point cuts. And I like to think outside of the box and think that if they are going to go for that 4%, I feel like it makes more sense that they do 225 basis points, pause for a little bit, and then maybe do a 50, or do 225, a 50, and then pause. I don't know. It's all gonna depend on what the data suggests at that point. But it's again interesting to see that their perspective is like the opposite of that. They're like, oh no, like this means that we're gonna get 4. Again, there's no right or wrong to this. This is all like the shady gray area type stuff. But it's interesting to look at their expectation, because my expectation would be the inverse of this, that like they're giving themselves to potentially enough room to do a 50 instead of adding 2. And again, there's like, we don't know, nobody knows. I mean, the Fed themselves probably don't even know. You know, these are all things that are going to be data dependent, and there's a lot of factors to consider, especially when you're looking all the way out through 2025. We still have, you know, half of 2024 left here. Anyway, the Fed has also raised inflation expectations slightly this year, and another sign that higher for longer is back. I don't think higher for longer ever went away. Again, this is another thing that confuses me about a lot of the people that put out this content. When did higher for longer ever go away? I've never heard Powell say that it was going away. I've never, like, this is like one of the things that, like, this only exists on like Twitter and in like a media. This doesn't exist in like the core source information. The Fed has never been like, hey guys, you should expect, you know, I mean, they kind of with the dot, like the plot dots can maybe suggest that sometimes, like they can look at this, whereas, you know, we're tightening up a little bit here, but even then, I don't think that they ever implied, especially like Powell in his speaking, has never implied that like higher for longer was ever not an option. It's just that's one of the things they've been firmest on. Higher for longer, higher for longer. I never got the tone that this went away. So again, this like weird opinionated stuff is like dangerous for people that read this, because again, this like the average person is like, oh okay, like we weren't expecting higher for longer. It's like, no, the Fed was very clear that it's always would have been higher for longer. And we can only use that phrase for so long, right? Because once we get like, I mean, like by September, like I don't even feel like we can use this phrase no more. Like we're gonna start cutting, so we gotta stop using this, and we need like a new phrase, because this is no longer accurately descriptive of the type of market we're heading into, or gonna be heading into in like September, October, November. As we've seen all year, the Fed press conference is the most important part of the day. Yeah, which we got 5 minutes for, so we're gonna see what's good with that. What has Mark posted? The M2 money supply? Yeah, that's, I mean, that's just an infinitely bullish chart. That's Alright, we got Powell up in 5. I'm gonna try to do something here with my charts and the stream family. Give me 1 second. We're gonna try something new here. What do you guys want to watch? We'll watch the dollar index and the NASDAQ. And then we're gonna do this. Alright, let's try this. How's this look? This look good? We vibing? Make this a little bit bigger. Bring Mr. Powell front and center there. Look at that, we get fancy with it. Just make sure that it's live. We'll mute that for now too. Look at all those paid actors. Oh, what's good, Renee? What up, brother? Hopefully you've been having a good trading week, my guy. Valid, St. Lakes, okay. Yeah, I've been slowly investing in some stuff for increasing the set production here. Unfortunately, my computer's been having some issues. I think one of my RAM cards is starting to fail me, so I'm about to get like 64 gigs of new RAM and install it in here, because I'm operating on 16 gigs of RAM as if it's like 2012 or something. So we're gonna upgrade to 64 and then get some additional stuff. Ideally, I want to get like 2 cameras set up, so I could, you know, do some switch cams and stuff like that. Actually, I don't know if my webcam's plugged in. It's not. It's mad dark in here anyway. NQ still responding good off this liquidity. Again, the dollar index fading a little bit of its move. Again, the dollar index mainly gaining strength because the Fed has apparently, quote-unquote, brought back higher for longer. Basically just adjusted some of the economic projections, forecasting, you know, at most 2 rate cuts for this year. But nonetheless, rate cuts are coming, and that's all the market cares about. And the market will continue to print all-time highs, family. Do not be confused about it. How's crypto doing? 69? Okay. Bitcoin will be at 80K soon. Have no fear. I feel like I've been saying that for like 2-3 weeks now, but I will say it till it happens, because as you guys know, I'm bullish as all hell on crypto until I die or SHA-256 dies. One of the two. Yes, sir. I passed top step and just taking my little base hits. No more swinger intraday, so just being patient, taking what the market gives me. I saw you had a good week so far. Yeah, man. I didn't even really... I mean, I pushed some buttons last night, and I lost a little bit of money, so I'm a little bit down compared to what is publicized. But yeah, I should be able to wrap it up with at least $2,000, if not more, if I trade into the end of week here. So it's not terrible, man. Although, had I played last night a little better, it could have been a fantastic week. I say that as somebody who probably should have had like a $15,000 day. But again, it's I didn't, and that's just the fact. So can't sit here and dwell in what didn't happen. There's no such thing as a could have been millionaire. Or well, there are, but nobody cares about those. Oh, somebody texted me saying coin is doing very good. Yep, at 262. Let's go, baby. Alright, it's 2:30, Mr. Powell. Where are you at? Let's turn down the music here in a moment once he comes out. Pull that up real quick. That down. We live. You guys can still see the stream, right? Alright, cool. Oh, there he is, the man, the myth, the legend.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone.
Am I crazy? Is that not
Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain
So some things I want to pay attention to in the questions is, again, they keep noting that the labor market is fine, and again, they're not entirely wrong, but I still think the path is not a great path. I'm curious what they deem as high. Again, they say that 4% is an acceptable level, and 4.2 would remain acceptable. What is unacceptable? That's what I'm trying to figure out based off what people hopefully ask him. Everything he's saying now is stuff we already know. So,
power, especially for those least able to
the
meet
data
the higher
that
costs
just
of
has been released over the past
food,
month or
housing,
so, the last 2 months.
Our monetary
So
policy
we'll see when he starts getting questioned on what he has to say more about that labor market. See if he does highlight a specific number or like data range where unemployment would maybe start becoming a problem. Again, I would estimate around 4.5%, and they're probably not going to be able to make the same comments they're making now. So we'll have to continue to see what happens.
The risks to achieving our employment and inflation goals have moved to is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability.
I love his little disclaimer. Here's our plan, but that's not our plan.
If inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamaros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many, because really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see
Another
that.
thing that
And
will
we
happen.
do see today's report as
Like how he puts that in there,
as
right?
progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today to the extent you can, reflect it in one day. I think we'll see PPI tomorrow. We'll know more about
I interpret that
as the month
as
goes on, but the initial CPI reading.
a majority of them probably didn't change their decision based off today's data.
We were briefed about it.
And the reason why you'd want to know if that's important is because if they're not putting it into account for this meeting, then they're definitely taking it into account next meeting, which again, may change some of their opinions.
Hi, Chairperson Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So if you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still
I'll explain what that is
greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago or even 1 year ago.
So what they were talking about there is the disparity between a household report and the enterprise report, and basically what's happening here. And again, we kind of brushed on this a little bit, but in the most recent jobs report, there was primarily two things that probably affect this. One was that full-time jobs decreased by like 450,000. And part-time jobs increased by 600,000, giving again the net difference of 280 or whatever the hell it was, right? So this makes a little bit of sense because again, if you're surveying households and those people are primarily telling you that they're losing their jobs, but the enterprises are telling you that like they're hiring more people, and that jobs numbers look great, it's like, well, the people that you're surveying are probably the people that are losing those full-time jobs, and then the enterprise is taking that full-time job and splitting it into part-time jobs, and that counts as two. So it's like you're losing one, but you're gaining two. But it's like, in some cases, you're even gaining three because they might take a full-time person's responsibilities, break it up into three different things, and you give those people, even cumulative, like less hours than you would the one person that was maybe doing like 40, 50, 60 hours a week. Um, so there's that, and then there's the other thing where again, like that, those household surveys are probably going to people that are primarily citizens. Yeah, again, they mentioned the immigration thing and like how immigration is like playing a factor in the jobs market and stuff like that. And again, regardless of how you feel about immigration, this is just pure raw like statistics. But the labor market, in terms of like U.S. citizen-based people that were being employed, so like no gain. If anything, I think it even went down. But jobs for people that are technically immigrants have skyrocketed. So it's like again, like you have all this part-time job creation because you're firing native-born U.S. citizens. You're firing them from your full-time jobs and replacing them with immigrant workers part-time. It's like, yeah, no wonder you're seeing an increase in jobs numbers. It's just like it's pure manipulation, really. So it's like there's no wonder the surveys are so different. It's like 'cause you're surveying the people that are getting fucked over by losing the full time jobs, and then you're also surveying the people that are fucking over those people, and then replacing them with somebody that you don't even survey. So it's like, it's interesting. Again, it's a problem that he's trying to skirt around. And again, like
Chair
they're not
Powell.
wrong.
Neil
Like,
Irwin
the
with
4%
Axios.
unemployment is like historically low. It's like again, it's not that the number right now is bad, but it's that these gradual increases are warnings that they're not listening to. And of course, you could argue whether or not they're aware of them, but they're currently putting on the face that it doesn't matter when it doesn't.
Back on the rates path, the SEP showed quite large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier,
It's 'cause you
in
guys
the discussion to
panicked
have
when it went up 2
now,
months in a
but
row.
ultimately, we think that things like the neutral rate are driven by longer run, slow moving forces. And, there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand. And that is complemented by and amplified, supported by
Actually, a pretty
restrictive
solid
monetary
question.
policy. So those two
think
things
it's
have been
gonna
working
answer it
together. We've
appropriately.
also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand?
Companies
And
care
we
more
don't
about the
know
bottom
that.
line and overhead
look
to
at today's
increase profit
report.
margins,
If we see more like
unemployment,
that,
well, that's the that's the
we
whole
can't
point of
know
a
what the
company.
future holds. But in the
I'm
meantime,
tired of
we've
people
made
using
pretty
that
good
as an
progress on
excuse.
inflation with our current stance.
Companies are meant to turn a profit, and you do that by decreasing your bottom line.
Michael
and
McKee from
increasing,
Bloomberg Radio and
your
Television.
prices to a point that
The base
market
case of the committee seems to be
sustains.
that there is going to be at least one
Like,
rate
it's the
cut
whole point
this
of a
year,
company.
but your growth forecast doesn't see any slowdown in the rest
Whenever
of the year.
people are like,
nor
"Oh,
does the
companies shouldn't make
unemployment
that much money.
forecast
They
see
should,
any, significant weakening
it'd be
of
for the people." Those are
labor
called
market,
non-profits.
and your
It's called
inflation
non-profit
forecasts
organizations.
basically
Those are not
average
called
out to
businesses
no
and companies.
change. So if at the end of the year
Companies
there is no
should be
change
for
from
themselves. It should be
conditions now,
profitable. Again,
why
they should be
would
somewhat
you
logical and
anticipate
respectful as
cutting
well.
rates? What-
Again,
what
like the
would be the
market, like
point
that's what the open
for a
market
rate
kind of dictates, right? It's like
think
if you're
policy is
just
restrictive.
overcharging it and people don't
We
see the
think
value in it, they're
ultimately
just not going to buy it.
that
It's like, but if
if
you
just
if
set
Walmart
policy at a
increases their
restrictive level,
prices and
eventually you will see real
and,
weakening in the
and
economy.
but their
So
demand for the
that's
product
always
stays
been
the same. It's
thought,
like, why
is that,
wouldn't they? Why
since
wouldn't
we
they do
raised
that?
rates this
Like,
far, we've
at the end of the
always
day,
been
that's
pointing to cuts
that's
at
what
some
they're
point.
supposed to do.
Not to eliminate the possibility of hikes, but no one has that as their base case.
My thing is always this: if you have a problem with it, go buy that company's stock.
but-
That's the best
so
way to
that-
fight
that's-
back. Is just
yeah,
go get
that's how we're
ownership over those
competitive.
profits.
That's what
Like
we've been getting. That's-
fucking
that's
instead of
what we've been getting is good
bitching that
progress on
Apple
inflation
consistently raises the price of Apple Music, just go buy Apple shares and fucking shut up about it and continue. It's like, I'm not saying this to you specifically. I'm just saying in general. I'm surprised that people complain about this stuff. It's like the same thing when like people were complaining. They're like, "Oh, the war is gonna make oil and gas go so high." It's like, sure, just combat that. Just go buy shares of oil. Like whether you're doing like futures or you own like a company that the profits from it, like go do something to combat it. Don't just take to Facebook and be like, "Oh, rah, 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 these fucking Walmart prices." It's like, okay.
Banks in leaving rates where they are for too long at this point?
That's what I'm saying. How can we? Yeah, exactly.
on
yeah.
housing-
You're right. No, you're 100% right.
Yeah, the housing situation is a complicated one, and you can see that's a place where rates are really having a
No, we
significant effect.
absolutely 100% do it to
I
ourselves.
mean, ultimately, the best thing we can do for the housing market is to bring inflation
Now
down.
they're talking about the housing market.
so
I
that
don't
we
really
can bring
care about
rates
the housing
down,
market.
so
If I'm
that the
being honest
housing
with you
market
guys.
can continue to
Again, I
normalize.
only really
There
care
will still
about
be
the
a
inflation
national housing shortage, as there
and
was
the,
before the pandemic. There will still be one, but the distortions that we see now with
in the
lockdowns
labor
and things
market.
like that
And
will have
again,
low
he's not really
mortgages.
giving us any
In terms
hints
of
on the
banks,
labor
the
market.
banking
Again,
system
like I had
has
this
been,
question
you know,
here, like when does
solid,
unemployment become a
strong,
problem?
well-capitalized.
Again, he's not really
lending.
answering this.
You know, we've seen good performance
Again,
by
I'm
the
going to just
banks.
keep with the
We
assumption
had
that
the turmoil early last
4.5%
year,
is
but,
probably higher
you know,
than
banks have been focusing
they're going to deem as
bringing up their
acceptable.
liquidity,
So
bringing up their
it's
capital,
probably a
and
pretty
having
safe
risk
spot for me
plans
to
in place.
again kind of
So the banking
continue
system, you know,
continue to target. It is interesting to see going up to 4.2%. I think the immigration problem and the fact there's not many, like he kind of spoke about this too, like there is like a surplus of like jobs like available. Like there's like I think job openings came out at like 8 million or something. Like there's a ton of opportunity out there. Some would argue that, you know, a lot of those jobs don't cover the cost of living, blah blah blah. And again, that's all a fair point, but the fact is they do exist. But even that's still like a pretty good decrease. Like I think it fell from like 8.4 million to like 8 million. So there was like 400,000 job openings lost as well. Which again, if you look at it from the perspective that, you know, 469,000 full-time jobs went, you know, we lost last month, and we gained 600,000 part-time jobs.
You know, and I think you
It's
can
like
see
that's
it
like
in
I view
various
that as a
places,
net loss
in,
of 200,000
in some parts
because
of,
theoretically you should be able to
non-housing
split a
services,
full-time
you're
job
seeing
into two part-time
lowering,
jobs at the
inflation
least.
still, and that's
It's probably not
to
the
do with
perfect mathematical way to do it. I'm sure somebody will be like, "Oh, it
prices
makes more sense to do it at, you know, this number, whatever." I'm gonna use rough numbers. I'm gonna say, you know,
prices on goods, which,
for every full-time job, there should be at least
you know,
like 1.8,
signal from that, but,
you know, part-time jobs from
and
that.
of course, housing services, you're seeing.
So again, like that's still net negative. It's like, cool, if we lost 600,000,
You know, catch up inflation from earlier pressure.
and we made, you know, I'm sorry, if we lost 400,000 and we gained 600,000 part-time, it's like I feel like we should have gained 800,000 part-time. So there's definitely a decline in it, man. I don't know
Above
what their numbers are that they're going to be looking for, but as long as unemployment keeps ticking up, I know that these rate cuts are going to get expedited.
we haven't thought of
And again, the labor market being strong isn't necessarily like, even if unemployment stays at 4%. Let's just say the Fed is right. Let's just say 4%, 4.1%, 4.2%. Like let's say it doesn't get ever any worse than what they're expecting. Let's just assume that case. That still doesn't mean that they're not going to cut rates, right? As long as inflation is sustainably coming down towards that 2%, consistently sustainably coming down is the words he would use. And like, as long as that's happening, they're going to cut rates no matter what. It's just that the higher unemployment goes, the better chance we have that they speed up that path, right? That we get there earlier, that they make these adjustments. And right now, they're not making those adjustments, which again is fine. Just generally no problem with that. As far as what markets are doing, let me shut him up for a second and bring some music back. And y'all let me know if that's like too loud or something. Anyway, what are markets doing? Dollar pulling back a little bit here. I'm gonna go back to the full screen mode. Dollar pulling back a little bit here. Again, I would still look for us to continue this to the downside. Again, whether or not that plays today, it's a little late in the day, but I would suspect during Asia, if we can get something above this this pullback here, again, I'll probably continue the week to see if we can target, you know, filling out this wick and basically just erasing this NFP move. I don't think we hold this NFP low in the macro. I think we are at the point where, if anything, this ends up spilling over, and we'll probably continue the path down towards 102.80. Of course, my thoughts on this could change, but as of right now, I seems doubtful. But we'll see what tomorrow's trading day brings us. But I'll probably be looking at some sort of continuation like this, moving into the end of week. Yeah, it's just like a ton of buy-side absorption. A lot of volume here, so if we can push up again here on lower volume, I'll probably look to take some sort of sell. Again, things like NQ, as we kind of discussed before, this is just a very easy liquidity play, man. Again, it dipped below the morning open price action, even gave you a little bit of retest. Now again, it's once again pushing for all-time highs. Nobody should be surprised about that. Gold, again, gold, pretty interesting. I'll see where this ends up, but I would love for this to come below like 23, 28. If this could spill over the rest of the night, you know, we could fill some of this out again into tomorrow, then I would again look to continue to the buy side here. But that's really just how I perceive the markets, man. It should be simple continuations once we take out some of the people that were again playing some of those news releases today. Alright, family, anything else? Anything final comments, concerns? Again, if you guys want to join us in the Discord for $1, which is our free community, make sure you guys head on over to the WAP. I'll put that link in the chat again for y'all. Or join us in the trade room if you want that over the shoulder experience when we try live trade during the New York session. It's been real. Again, I would in the macro here stay short the dollar. Again, things are going to get a little bit range bound possibly with some of the thoughts, but outside from that, I think it was a pretty successful FOMC, and I don't think the path has changed for us at all here in our community. Love and appreciate y'all, family. It's your boy Skag, and I am out for now. Enjoy Jerome Powell with some green laser eyes, baby, because that's what we doing. Printing money. Alright, fam. I'll see y'all. I'm out of here.